Hello, everyone, and welcome to episode number 83 of JustDario Cigar Time. I am recording this update on the afternoon of June 27 here in Hong Kong. Literally a few minutes ago, another news story broke. Iran launched an attack drones against Bahrain, and the UK MTO reported another oil tanker has been hit in the Omani territorial waters, the third strike in a row in 3 days. This follows what happened on Friday after the US market closed, when the US government retaliated by attacking Iran territory because of the Islamic Republic attacks to commercial ships trying to leave the Strait of Hormuz via the Omani waters channel. These ships were trying to use the corridor without coordination with Iranian authorities. As you can imagine, the first thing I did when I woke up on Saturday morning after reading this news was checking the oil price on weekend platform. And to my incredible surprise, there was barely an upward move. Only slightly above $70. But what surprised me the most was reading this breaking news. The US Pentagon delayed publicly announcing the strikes on Iran. They waited until after the US stock market had closed at 4 p.m. Eastern Time on Friday. This was as per NBC News. The timing was reportedly intended to reduce the immediate impact on financial markets. Dear followers, this is an incredibly big deal, way more than what is currently transpiring on social media. This is the very first time a mainstream media outlet has explicitly acknowledged that US government actions are tailored towards active financial market manipulation. This is something I've been talking about for a long time now. Today, I want to provide you with more evidence of this incredible market manipulation that is completely detaching crude oil prices from reality. Please have a look at the first chart. It shows the continuous trading of NYMEX WTI futures. The white area represents regular trading hours. The blue area represents overnight trading hours. I included several blue arrows on this chart to help you identify what is going on here. It should now be very straightforward for all of you to see how the manipulation works. For example, in the last month, every single day, without exceptions, the oil price was crushed during low volume US overnight trading hours. How can they even do this? During overnight trading hours, there is even very little news coming from the US government or Iran, especially during Asian trading hours. So the answer is very simple: price spoofing. If they were using another illegal trading practice called wash trading, the volumes would have been much higher. Now, I want to present a second chart. That is an even better example of the effect of this insane price manipulation on oil futures. As you can see in the highlighted part, crude oil prices have been crashing back to levels not seen since before the war started. This is without even considering that we might have lost 1.5 billion barrels of oil supply, according to the latest estimates. This without considering that commercial inventories across the globe are at multi-year lows. This without considering that the US SPR is at historic all-time lows. That SPR around the world are also at historic all-time lows. Yet, the oil price kept being crushed, especially in the last month. However, at the same time, the refining spread, the so-called crack spread for diesel and gasoline, have been going up, not down. This is the first time ever such a disconnect has happened. How do we explain this? It is because of the insane paper market manipulation. It's creating an incredibly high amount of artificial supply of oil in the financial market. In reality, in the real world, demand remains incredibly high at the same time. Many refineries around the world are operating at 100% capacity. Because of this very high demand and dwindling inventories, refining margins are going higher. They are not following lower prices lower, as should have been the case if everything was normalizing in the crude oil market, as they want all of us to believe. Now, before moving into the second part of today's podcast, I have an announcement for all of you. My dear followers, for a long while, many among you have been asking for more full details on my analysis and investment ideas. To answer all these requests, I'm excited to announce I've officially joined Slice as a mentor. Slice Finance is a new, fast-growing platform that has all I needed for sharing my market analysis, macro commentary, and asymmetric trade ideas tailored to subscribers who are professional and sophisticated traders. Furthermore, on Slice, I plan to host weekly live streams that will give my subscribers the opportunity to interact with me in real time. Nothing will change here on YouTube or X. What I share on Slice will be a new and deeper content layer for those who want to level up to a higher sophistication. Subscription will be at a fair monthly rate without any time commitment. If you're interested, check out the link in the comments. I hope to meet many of you on Slice. Now, let's get back to today's episode. In the second part of today's podcast, I want to begin with a very important update. On Wednesday, the EIA report showed another very large inventory drawdown in the US. This was mostly due to the US strategic petroleum reserves drop. However, if you pay attention to the numbers on the screen, there was another 6 million barrel drawdown in commercial inventory. This was compensated by an increase in inventory for gasoline and distillate fuel. The total stock drawdown, excluding the SPR, was 500,000 barrels for the week ending on June 19. Why was there this building gasoline and distillate fuel? As anticipated in my previous update, this was actually expected. Due to bad weather in the Gulf of Mexico that week, exports in the previous week were significantly impacted. This building gasoline and distillate fuel oil is likely to be reversed in the next EIA update that can potentially shock the markets with a historically large inventory drawdown as a result, because there will likely be a big drawdown in SPR, commercial inventory, and also in refined product at the same time. But the most important part of the report of the EIA was the official confirmation that there are now only 19 million barrels of oil left in Cushing, Oklahoma inventory. This number is incredibly important. Below 20 million barrels, the physical hub struggles to pump and transfer crude. Pipelines start to lose pressure. Blending operations become highly restricted. Refineries face immediate difficulties assessing the crude they need to produce fuel. Outbound flows and export shipments face potential curtailment and delays. If supplies are critically depleted, terminal and pipeline operators might invoke force majeure. This legally hunts supply commitments due to events outside their control. These are technicalities from oil engineers, not my own assumptions. Let me be clear. This is the reason why every single time Cushing oil inventories fell below the critical 20 million threshold, it was considered a very strong sign of tight supply and stress in the crude oil market. This is apparently completely ignored today because prices keep going down. But we know, as I showed in the first part of today's podcast, they are going down because of absurd price manipulation. This manipulation is completely distorting the perception of traders in the market, especially of those who only look at charts, dismissing fundamentals. Another sign that things are far from being back to normal is the number of crossings in the Strait of Hormuz. It's important to have an equal amount of outbound ships leaving and inbound ships entering the Strait of Hormuz to pick up oil supply. However, so far, less than 50% of the ships are inbound in the Strait of Hormuz compared to the one leaving. Most of their ships inbound are either Iranian or belonging to GCC countries. These countries are under strong pressures to take the risk to go back into the strait, despite Iran and the US resuming bombing each other. And after the recent military escalation, it is fair to expect the number of inbound ships will be even lower. Exactly because of this, the rates to rent oil tankers, especially to go into the Strait of Hormuz, are skyrocketing. There are reports of some tankers heading to India being leased at 9 times the pre-war price. Furthermore, many insurers are unwilling to provide cover for any commercial shipment venturing within the Strait of Hormuz still. So, after the great escape this week that created a brief pickup in traffic, mostly because of the use of the Omani water lane, a use that is now challenged by force by the Iranian Republic, it is fair to expect traffic will go back down significantly. Traffic that, let's not forget, barely reached 30% of the pre-war level. All in all, things are not normalizing in the Strait of Hormuz. Period. This is contrary to what the market price wants everyone to believe. I want to conclude this section by showing you a chart I put together. As I have said many times, history doesn't repeat exactly, but it rhymes. In financial market, especially in the short term, the psychological factor and market manipulation can create similar circumstances to the past. And as you can see in the chart in front of you, the current heavily manipulated price action of oil futures is incredibly similar to the behavior of Volkswagen price during the great financial crisis of 2008. At that time, there were continuous rumors that Porsche was accumulating shares of Volkswagen in the market. But since they were doing that using options and equity swap, not purchasing shares outright, traders were misled and ignored the rumors. They shorted an incredible amount of shares in the market. However, when the news became public that Porsche had accumulated a 75% ownership and the delta hedging of that ownership accumulated via derivatives effectively collapsed the float available in the market, there was panic among short sellers to cover their position. This ultimately ended up with the historic spike of Volkswagen shares from €200 to above €1,000 in just 2 trading days. Let me be clear. I know that crude oil and the shares of a car company are two very different things. But the point I want to make here is that the situation is becoming so stressed right now in the crude oil market that it resembles what occurred to Volkswagen in 2008. Remember that at that time, the price action occurred while the overall market was crashing because of the great financial crisis. Another similarity that might occur again today. As I've been proving over and over again for weeks, the dislocation between reality and the financial market in the crude oil right now is extreme. So this kind of abrupt spike in volatility and price action should be taken into proper consideration. It should not be easily dismissed just because it never happened before. Paradoxically, this type of spike in the commodity market has happened multiple times in the past. Recently, in silver, although the situation was not this extreme, there was another instance in 2022 with nickel, where there was a massive short squeeze. Considering that right now, even the number of paper shorts positioned in the oil futures market is at an extreme high level, as I showed you in my last update, the chances of this massive spike scenario happening are not zero. Albeit you might consider them to be low, in reality, traders are pricing it at basically zero chance for this event. But the chances for this event are, in reality, material. Before we continue, if you like my content, don't forget to like the video, subscribe to my channel, and turn on the notifications if you don't want to miss any of my future updates. To conclude today's podcast, I want to show you other assets that are screaming warning signs that something is very wrong in the market. The first are gold and silver. In the past week, they have been both suffering significant losses. Gold is down almost 2%. Silver at some point was down almost 14% on the week, even though it recovered on Friday. Everyone with experience in the market will tell you that when this happens, it is a sign of liquidity stress somewhere in the market that has yet to surface. This is aligned with what I warned you about in my previous update on gold and silver, on what I expected for their price action in the short, medium, and long term. In the short term, I expect that a sudden shock in our prices will be bearish for gold and silver. The shock will result in a significant liquidity drain and spike in risk in the financial markets. This will force many operators into liquidating assets that can fetch better liquidity, like gold, silver, or government bonds. The Japanese yen is saying something very similar to gold and silver. Despite the incredible jawboning of the Japanese government and some attempts at intervention during the last week that barely lasted a few minutes, the Japanese yen closed this week near the lows of the past 40 years. As you can see in this next slide, the JPY is literally on the brink of imploding. If this resistance is broken, the next one is going to be around 180. And after that, 200 against the US dollar. That is a massive depreciation risk in a currency that not so long ago was considered a stronghold in the financial market. It was considered a safe haven where investors could find shelter in case of turmoil. Now we know that volatility can spike at any moment, but there are fewer places where investors can hide. A break in these important assets will also create significant disruptions in the JPY carry trade, a vital source of leverage for the global financial system. With it, many foreign assets, especially US dollar fixed income, government bonds, and stocks, have been purchased on leverage for many years. So, if the JPY implodes, the carry trade takes a brutal hit. This will force selling into foreign assets, eventually exacerbating the downturn in those. This will also increase a volatility spike risk because of an eventual escalation in the oil market and the war in the Middle East. Here is where I want to conclude today. The signs of stress across global markets are rising. This week, there was incredible volatility in Japanese and Korean stocks that shouldn't be ignored. Some prominent asset managers are now coming out and saying out loud that they think the AI bubble is close to bursting. We know there is immense stress in the crude oil supply in the system, while prices remain incredibly suppressed. This can create a huge risk shock in the market. And important macro assets like yen, gold, and silver are screaming danger at the same time. This is not the time to have fear of missing out. This is not the time to have euphoria. This is the time to take a step back and consider everything carefully. Apply careful rules of appropriate risk management. Because whenever the trigger is pulled, things are going to move so fast that nobody is going to have time to escape the burning theater at that point. Thanks a lot for listening to my podcast again today. Thank to all of you for supporting me on X, on Instagram, and for reading my research on JustDario.com. Please drop a comment to let me know how do you think about today's update, and feedbacks are always appreciated. I wish everyone a nice day. Bye.